Welcome to Tech Poutine.
Just raise your hands who never heard the Tech Poutine podcast before. We love when it's their first time, don't we? So you're going to hear about the state of the venture capital on the investment side in general. And we have four speakers today who's going to do the Tech Live podcast. So we have Gabriel, Ian, Eleanor, and Nectarius. And obviously we have today a special guest, which is not me, which is John. And John is leading the investment side at RBC. And he has a great profile. He was at Shopify and different firms before joining the bank. So please welcome our crew for the next podcast.
Hi everyone, we're here for a special live recording of the Tech Poutine podcast. Usually it's just the four amigos here where we get together and talk shit about what's going on in the Canadian tech. But we have the distinct pleasure of having a special guest today, a gentleman to my left here, John Rikhtegar, who runs capital at RBCX and is, I think, the leading voice of just what's going on in the world of VC from a data-driven perspective. So I think we're very happy. If you're curious about it and actually want to know not just people's opinions, but actual data, I think John's the guy. So we're very happy to be able to, that he accepted. And I'll kick things off with a very kind of simple question. John, you just presented at FunFest with Peter from Carta, showed some very interesting data. And there's been a lot of talk about the fundraising market, the ups and downs, the potential rebound. What would you say is going on today in Canadian VC? And then maybe a corollary to that, why? Why are the changes that we're seeing?
Yeah. First off, thank you all for having me. This is a blast. This is the first live podcast I've done. Hopefully not the last. So for those who don't know me, as Nectar mentioned, I'm John Rikhtegar, Director of Capital at RBCX. So I lead all of our fund direct investing and then all of our kind of data-driven thought leadership that we put out in the market. I think the market's in a very interesting spot. I've been doing my specific role for 4 years. So this is the first kind of cycle that I've seen at least. And I think when I think about the market, there's a few things that are probably worth mentioning. The first being with respect to market cycles. So venture capital has very unique market cycles. And for those who know Bill Gurley, who is a very revered investor in the US market, he describes the market cycles in venture to be less like a sine curve. We have evenly distributed ups and downs and more like a sawtooth wave where you have a gradual risk on investing period, a peak liquidity window at the top, and a sharp and abrupt risk off decline. And we're at that bottom right now. And, if you even take a step back and you think about the time between the last three downturns we've had, if you go back to the early 2000s with the dot-com boom and bust, and then the global financial crisis in 2008, and then the trend that went from 21 to 22, this past downturn, GFC to 2021 was the longest period between any two recessions that we would have ever been through. And what that also means is it was the longest bull market we've ever been on. And so what that also means now is this is the biggest downturn that we've been through. And so it's incredibly uncomfortable. But what I'd say right now is it's actually normal to be as difficult as it is because of how significant of a run we were previously on. I'd probably say that's the first thing. The second thing that comes to mind is we have to talk about AI because it's everywhere. I was reading something from PitchBook, and I think it said that in the first half of 2025, AI made up 76% of all capital invested in venture capital across North America. 76%.
And it's very concentrated in a lot of large deals, if I'm mistaken.
But I just read that. And you know what's really interesting? I don't know. I'm curious if you all have a perspective, but the premise of AI is to make things more efficient and to make companies more efficient and essentially mean that companies probably don't actually need to raise as much equity capital as they previously used to. But there's also record amounts of dry powder. And dry powder, for investors who aren't in the room, essentially is money that's been raised by VC funds, but hasn't actually yet been invested into companies. So there's a lot of money that's on the sidelines ready to be invested because of the crazy fundraising environment that we went through. But AI is making the premise that companies actually don't need that much money and should actually be more efficient. So there's this juxtaposition happening where AI is taking all the money, potentially the asset class got a little bit overcapitalized, and now we have to see how this money actually gets deployed efficiently. That's two anecdotes that I'll share as to what I think about in the market.
So what do you think the outcome of that will be, given with all that dry powder? More deals?
Personally, I think that there will be more deals. As Eleanor said, there's a lot of big funds with a lot of money. So that dry powder, if you look at the hundreds of $billions that's available across North America, a big chunk of that comes from a handful of funds, which will deploy in more late stage, really capital intensive businesses. But I think personally, the venture market will probably get rationalized. Like we'll probably see a lot of funds that were raised in prior years will come back to market, and not everyone will have an easy time raising their next fund. And that will trickle its way down to founders, because then founders will potentially have a few less venture investors that they can go pitch and potentially raise capital from. So it definitely impacts the entire ecosystem.
Does that align, Eleanor, with what you're seeing at your fund?
Yeah, I was saying like on the ground in Canada, at BrightSpark, we're lucky enough not to be in fundraising right now. But what we hear over that, we're probably at one of the hardest time in at least over a decade to raise a VC fund. And I believe that's true in the US as well. But at the same time, as you just said, there's a lot of dry powder, a lot of funds that raise in easier years are sitting on a lot of capital. And with all the dynamics, do you think it will get back to being easier to raise a fund? Or is this like a paradigm shift where the way LPs deploy has changed for a little bit?
Yeah, so that's a great question. I'll answer it in two parts. I think the first part to Eleanor's question, do you think it'll come back? Absolutely. So the thing about market cycles, and I was mentioning this earlier today at FunFest, the market cycle goes through this cycle called the capital cycle theory, which is essentially saying in 2017 to 2019, returns in venture capital were really good. And so in 2020 and 2021, it attracted a ton of money from a ton of investors. And now what's essentially happening is returns are getting hit. They're not actually as good. And the reason why they're not as good is because there's too much money chasing too few deals. And then what will happen is naturally investors will realize that the venture market is not as lucrative as they once thought. And so money will leave the asset class. And as money leaves the asset class and we cleanse it and it's more capital efficient, returns will get stronger. And so it's this cycle. This past cycle took 12 years to go through that. But my thinking is returns were great. Money flocked to it. Now returns are bad. That's where we are now. We'll start to see investors pull away from the asset class, which will actually be beneficial over the long term because it'll help returns. That's the first thing I'll mention. The second thing I'll mention with fundraising, again, to Eleanor's point, fundraising right now is at decade lows in venture capital. Like it's very difficult. If there are any investors in the room, or if you talk to any venture investors, it's very difficult to fundraise for new funds right now. And most people attribute that to a lack of exits. Most people, we hear of some of the big IPOs in the US market like Chime or like ServiceTitan or CoreWeave, but there's only a few handful of those companies. But what I'll also say is the lack of exits or lack of liquidity is actually only 50% of the reason why fundraising is really low right now. The other reason why fundraising is really low has to come down to the venture cycle, which I mentioned. And we actually put out some data last year, and it looked at the past decade of exits in Canadian venture. And what we found was over the past decade, 50% of the exit value from Canadian venture came in just 2020 and 2021, which is pretty remarkable. And so what happened then, therefore, is I would have never thought too much liquidity or too much exit value could ever be a bad thing, but I think too much unpredictable exits could. And what I mean by that is I think the biggest consequence that came with 50% of our exit value over the past decade, come in those 2 years alone, is it allowed fund managers to raise bigger funds, raise them a lot faster on more expansive fund strategies, and then a ton of new funds got money. And so LPs over allocated in 21 and 22. And so going back to the fundraising difficulty, yes, exits are bad. But the second piece is LPs are having a record amount of capital called that they've ever been through from investors who they've fundraised from in 2021 and 2022. So they're getting hit by not a lot of money coming back, and their capital is getting called by asking a lot of their capital from their GPs who are actively deploying. So that's why fundraising right now is getting hit almost like a double whammy.
Interesting.
And John, you talked about early exits and IPOs and things like that. We often hear about how Canadians need more ambition and we need to think bigger. We now have a significant amount of big companies in Canada, startups, well-funded, doing very, very well. But when you look at that compared to the US market, we pale in comparison of size. So can you talk about a little about what that means for Canadian startups, VCs? Like, how do we get to a scale that we're smaller than the US, but we can still have more Shopify's? Like, how do you see that?
Yeah. Listen, I don't have an answer, but that's a big question. But what I can say is I think Canada and Canadian Venture is in a unique position right now where we have a disproportionately large amount of late stage private companies in Canada that have raised venture funding. And the reason why that's the case is because, quick history, there was this program called the Venture Capital Action Plan that started in 2013. And the purpose of that plan by the federal government was to help get private investors investing in venture capital. And so they essentially had 4 big fund-to-fund investors. They seeded them with a bunch of money. Those fund-to-fund investors invested in a bunch of funds, and then that allowed our ecosystem to start getting built. those fund of fund investors invest that capital over 2013, 14, 15, and 16. And so the reason why we have a big significant amount of late stage companies right now is because when you think about 2020 and 2021 and all the exits that happened in those years, it was actually the funds that were vintage years 2010 to 2011 to 2012 that really benefited from that exit window. Because if you were investing in a pre-seed company in 2010, it took 10 years for you to be able to mature into an exitable business. And they were the ones that were able to take advantage of the exit window. Because we only started to institutionalize Canadian venture in 2013, and those funds started to get deployed between 2013 and 2017, we actually didn't have a ton of late stage inventory that could take advantage of that liquidity window as well as the US market could. But now we do, because now we have a ton of inventory. So the thing that I think about when the next big wave happens, the next big cycle happens, is how are all these late stage companies able to exit at exit values that justify the amount of capital that they raised in their business over the course of the past 10 years? I think a lot of that comes from having a healthy exit environment. And I think a lot of that comes from being able to work with both Canadian and US investors on their cap table.
Something I've heard you say, John, in the past that was a very ha-ha moment for me is like, always compare like Canada to the US in terms of it's much smaller. We're smaller population, smaller economy, our venture market is much smaller, but of this kind of chart on the slide where it shows we're kind of, I don't remember the number of years, but like 15 years or 20 years behind the US market. And you talk about the institutionalization of that market with proper LP, and we say the word LP, it's the investors who invest in VC funds, limited partners that are starting now to get into the asset class in Canada, but they've been doing that for 20 years in the US. Can you talk to us a little bit about that timing lag?
Yep.
Canada versus US, and what does that mean for the future, both for VC investors and for startups in Canada?
Yeah, it's a great question. I think what Eleanor is referring to is we ran some analysis and we essentially looked at if venture capital was a company, we essentially recreated the cash flow statement of venture capital. And we looked at it across both Canadian and US venture. And so what we did was we essentially looked at, and this is just from a bunch of different data sources, but we looked at how much capital has been, broadly speaking, invested in the asset class. So how much money has actually gone out and how much money has then came back through distributions or exits or realizations on an annual basis. And so what that allows us to do is it allows us to then understand in each year whether venture capital in Canada or in the US was a net cash flow positive, i.e. there were more exits than there were investments, or net cash flow negative, i.e. there were more investments, money out than there was capital coming back through exits. And what we found was over the past decade, essentially in Canada, there was only 2 years that were net cash flow positive, meaning that by and large, in every single year over the past decade in Canadian venture, the majority of the asset class has been net cash flow negative. But if you look at the US over their past decade, it's the complete inverse. The majority of the years are net cash flow positive. There were only 2 years that were net cash flow negative. And so a lot of investors look at that and they say, okay, John, if you're telling me that the US market's net cash flow positive and the Canadian market's net cash flow negative, why would I invest in Canadian venture? And to Eleanor's point, what I'd say is you're really comparing apples and oranges. Because what you actually have to do is you have to compare the past decade in Canada, which is what I call their institutionalization phase. As I mentioned, we started institutionalizing Canadian venture in 2013, with the decade of 2 decades ago in the US market, when they were actually institutionalizing their market. Because right now, the past decade for them was more like their maturation phase. And when you actually compare the past decade in Canada to that of 2 decades ago in the US, the data is identical. In that decade in the US, there were only 2 years that were net cash flow positive, and the remaining 8 out of the 10 were net cash flow negative. So I say that because venture takes a lot of time. You all know this. Like venture, especially early stage, like these are 10 plus year exits. It's a slog. It takes a lot of time. But I think based on where we are in our own ecosystem development, based on where the US was, given that they're at least a decade ahead of us, I'm confident with where we sit right now.
Yeah, it's interesting because it makes me think of the analogy of like French wine. Well, it's like, who makes the best wine in the world? It's like clearly the French, right? Well, because they've been doing it for a long time. So it's similar in Canadian VC where it's like we're 1 or 2 generations in and not 15, 18 like in the Valley. And then maybe the trend I see happening, everyone's talking about, you mentioned Milk earlier, right? This kind of barbell that's happening in the US, right? You have these big funds, mega funds. You spoke about it with Peter before, right? Like multi-stage, going down to seed, but also doing all the growth rounds. And then you have on the other side of the barbell, specialized niche or vertical funds. That seems to be the thing that's happening more in the US. Do you see that trend here in Canada, specifically when it comes to fund formation? Like I'm selfishly asking you as an emerging manager, hey, how should I think about my fund strategy moving forward? Curious to get your thoughts about good fund formation here.
Yeah. And I would throw it to Eleanor as well if she has any commentary. But so one of the things I do at work is I invest in venture capital funds on behalf of RBC. And there's many things that we look for in a diligence process, but there's three broad things I'll mention which are probably relevant. The first is we want to make sure that the investors or the VCs or the GPs, the general partners that we invest in, ultimately have credibility. And when I say credibility, that means credibility to access the very best entrepreneurs and founders and the ability to obtain their target ownership and their allocations in those companies. And credibility could take the form of their personal brand, their investment track record, their operating experience, the networks that they hold. But I think the most important piece of investing in funds today in GPs is because the market's gotten so competitive, there's so much money chasing so few good deals, really making sure that you're investing in a team that holds strong credibility and is valuable in the eyes of the entrepreneur, I think is the most important thing from an LP's perspective. The second thing I'll mention is to your point on fund formation. I think right now, more than ever, what's important is to be able to have high ownership relative to your fund size. And I know there may not be many investors in the room. The reason why I say that is when you own a lot of a business, you rely a lot less on outlier type exit outcomes to make the math work on your fund. And I think what we've realized over the past cycle is outlier exits are outliers, like very rare. So I think high ownership is very important. And then the last thing I'll say is, one of the things that we've focused a lot about over the past year is inception stage investing. So pre-seed investing very early. And the reason why that's super important is twofold. The first is, again, going back to AI, what we're seeing companies raise a little bit of seed and then not that much thereafter. And so Series A funds right now are shaking in their boots because they're like, holy cow, we thought we'd have so many more of these seed stage companies coming to market. But what we're realizing is AI is making them more efficient, that they don't actually need our money. And so now AI companies are like, okay, if we don't go earlier, then we're not going to be able to get in at all. And so that's why we're seeing so many funds go earlier and valuations at the early stage get really high. So inception stage is very important. And the second reason why is because that's where you get the biggest outperformance. If venture is all about trying to hit those top decile, really outlier type returns, whether it's a company or a fund, you need to be able to go very early, keeping your fund size small and trying to striving for outperformance that way.
I'll change tracks a little bit. As you mentioned, probably not a lot of investors in the room, but maybe a lot of entrepreneurs, founders, aspiring founders. For the ones that are listening to concepts of super cycles, it sounds, or it might sound like it's the worst time ever to start a business. Is that your perspective, or is it potentially the best time?
Yeah, great question. If I had to go in one camp or the other, I'd say it's the best time. And my reason as to why that'd be the case would be for two reasons. The first is, so there's this big investor in the US called Stepstone. They invest a ton in venture capital, and they put out a report, which is really interesting, which essentially looks at their total venture capital portfolio returns from 2000 to 2022. They invested over 1,000 funds. And what they found was 80% of the entire return in that entire portfolio across 22 vintage years, 80% came in just 6 years. 95% came in just 8 years. We're friends with the team at Stepstone. And so I messaged them and I say, okay, what are those 6 years that are responsible for 80% of the return? And they gave me the answer. They said, the 6 years are 2001, 2008, 9, 10, 11, 12. What are interesting about those vintage years? They're right during or after a downturn. Yeah. And there's an old adage, which is never waste a downturn. I think now is an amazing time to be building and investing because if data means anything, it's shown that these vintage years have been very much so strong for outperformance. What I'll say though, on top of that, again, in the spirit of AI, another data set, which is really interesting, there's a gentleman named Eric Paley, and Eric Paley runs a fund in the US called Founder Collective. And even if you're a founder or investor in the room, I think you'd find this data really interesting. What he and his team looked at is they looked at the past 20 years and they found what was the most valuable venture-backed company that was founded in each one of those years. And then what they then looked at is they said, okay, what was the hottest VC theme to be investing in each one of those years? And what they found over 20 years is not once was the most valuable company that was founded building in the sector that was hottest for VCs to be investing in that 1 year. Yeah. Which is pretty crazy. And so if that means anything, that probably means that the most valuable company built today
is not AI.
Is not AI, which is insane to think about because that's all we're ever talking about.
Yeah. Oh, shit.
We got to pivot. Okay.
Yeah, don't raise an AI fund today.
But I could be totally wrong. Yeah. But that's what I mean. It's venture's all about being non-consensus. And as a founder, having an insight as a founder, you're a resource constrained entity. So you're not going to win if you're building something that's consensus, because if it's consensus, a bigger business with more resources is going to do it. You have to have a unique insight that you can actually see that no one else sees, that allows you to be weird and wonky, that'll attract capital so that you can find your way to the end zone.
Yeah, that's very good. One of the best nuggets I had recently about the venture market was don't try to be the best, be unique. Because when everyone tries to be the best, you end up trying to all do the same thing and you create hype and no differentiation. If you really double down on what you do best, and it's true for founders as well, then you win your own game. You don't have to play the game that everyone's else doing.
There's a really good book on this back in the day. So this gentleman by the name of Seth Godin, modern marketing book, but it's applicable. It's called Purple Cow. Purple Cow Marketing, right? Yeah. Because a purple cow it stands out, right? Yeah. So it's the same thing, right? You don't want to be running towards the same direction as everyone else.
I'm curious if y'all have perspectives. Like when you think about this market today, like what's exciting for you today? What makes now either a really scary time or a really exciting time when it comes to investing or building?
Start with the founders up.
Yeah, we'll start with the builders.
Yeah, unfortunately, right after your comment, it feels like it's a once in a generation, once in a lifetime opportunity to build with all of the great technology that's coming out with generative AI. So super excited about that. It really feels different than the cloud movement and the mobile movement. It feels very transformative. And so really excited about that aspect of things.
Mm-hmm.
To me, I think it's about the speed of execution, right? And I saw the end of the previous talk, but like first business I started was 20 years ago and pre-mobile pretty much. We're at the beginning of mobile, and learning on mobile was a fucking nightmare. There's no analytics. And today, like you can just run these tests and move so much faster, and the smaller teams. And there's this period of which like you'd meet a founder. So how's it going? Oh, we're 120 people. And that was a sign of success. You had a big team, and now it's, we're 2. And that's, so all of that sort of acceleration is really exciting. And I think it's going to be really transformative for everything that we're doing.
Yeah, I think most founders I'm talking to feel super powered. They're really getting a lot out of small teams. And when you're a smaller team, you reduce the complexity in terms of communication. And so what's the Amazon rule? You have to have like enough people.
Two pizza team.
Yeah.
And so you can build
that's the business, right?
Yeah. You can build an entire company with 2 pizzas. And so it's really empowering.
Cool. Maybe the investor hat, and I'll ask Eleanor as well. It's like, to your point of, well, maybe AI is overhyped, but it's the way I see it, it's almost like AWS in a certain extent. It's like, it's so obvious today, but it's like what AWS managed to do is just drop the cost of starting a startup by having computing and being done in the cloud. So that's what it's going to be for startups. So it's, for me, it's the AI plus, right? It's not just pure AI startups, but every other sector that is going to touch. I think that's what's interesting. You mentioned the point, which I completely agree with, because it is the best time, because now you can build. You don't need to have strangers in your cap table. You could just do it yourself if you want. Yeah. So I think that's the beautiful part. It's going to enable entrepreneurship at a much broader scale, because there are no shortage of problems to solve in the world.
Yeah, I totally agree. I think this is like super exciting, but also super scary is standing as a VC. I think the technology today allows to unlock really big problem in industry that were considered less sexy by VC, and anything in the real world, like real things in climate, in biotech, or like now there's because of AI, you can actually unlock things you could not do in human biology. And just as an example, so I think I'm really excited about that. I think a lot of the more traditional VC investment spaces of the last 2 decades almost, which were at the end of the day just software as a service, like service company or e-com company or real estate companies. Now these companies, I think, which is a good thing, will probably try to build companies that are cash flow positive very early on, as they should. If you sell a good, you're supposed to make a margin on that good. You cannot subsidize this with venture money for a long time. But that means a lot. Like what keeps me up at night is like a lot of them, my smartest friend, are starting businesses, but they're like, I don't know, I don't want your check. And it's not personal. It's like, why would you raise equity if you can bootstrap and actually build something meaningful? So I think this is somewhat of a wake-up call for investors, but at the same time, there's really good deep tech, art tech entrepreneurs trying to solve really big issues that will require VC money. And it's a bit going back to the root of why venture capital was created in some way.
Yeah, one interesting trend I'm seeing, and it's a shift more into software space, is you hear a lot of investors. I was talking to a friend who's a partner at YC, who are telling companies not to pitch them software for industries, but to pitch them being the leading company in that industry.
Yeah.
Interesting.
So don't pitch me software for management consultants.
Yeah.
Pitch me why you're the next McKinsey.
Yeah.
And so I think that's an interesting trend. And it's something that I'd say investors used to shy away from. They wouldn't want you to try to go after a market that didn't feel scalable. But now with Gen AI, or AI in general, you can be those companies and get to scale.
And I'll just add, don't want to generalize, but sometimes in Canada, we tend to be more risk averse or lagging behind on some of these things. And one of my worries is that people will do that in the US, and then in Canada we'll be like, no, don't be a legal firm, sell your software to law firms. And I hope we don't miss that train. And it's just having the confirmation and the permission of the ambition and thinking out of the box, because the model is changing.
Mm-hmm. I like to say, you guys have heard me say this before, but I learned a new word recently, profitability. Right? I never had that as a concept as someone who raised a lot of venture capital. And I think the next time around, having that as a focus is a game changer. And I think will definitely change the way in which I behave as a founder. And I think that's actually a good thing for the entire ecosystem, right? Just like, it's no more about bleed cash until you might make money and figure out later.
It gives you a lot more optionality as a founding team or as an executive team, is like having a path to profitability, which is now possible because you can use AI to do a lot of the roles that typically will require hiring a lot of people, like sales, customer service, etc. You're able to use the new tools to be able to replace that.
Maybe a closing question, John, for you would be, there's been a lot of reports about fundraising in Canada, the CBCA data. What are you most optimistic about over the next decade and for the state of VC and for entrepreneurs in general?
Yeah, I would love if you have a perspective as well. My perspective would be technology is obviously going to be way bigger in 10 years than it is today. So everyone in this room is going to benefit from that macro. But when I think about what success looks like, Harley Finkelstein put out a post on LinkedIn. This was like a few weeks ago. And it was a chart, very simple. It looked at the top 5 companies in Canada and the US by market cap, and then looked at the year in which they were founded. And so in the US, you had, unsurprisingly, NVIDIA, Amazon, Apple, Google, Microsoft, all founded late 1900s, early 2000s. In Canada, you had Shopify, founded in 2005. And then you had Enbridge and TD, founded in the early to mid 1900s. And you had Brookfield and RBC, founded in the 1800s. And so what's the insight? The insight is the biggest companies in Canada were founded in the 1800s and the early 1900s. The biggest companies in the US were founded in the late 1900s, early 2000s. And that's pretty eye-opening. And so I think what success looks like is I would love to see a company that was built over the past 25 years hit that top 5 by market cap, that was venture-backed, that's a technology company, and that we can put into the next kind of level. I'd also love to see us, given the fact that these companies take a long time to build, us actually seed the next 2.
Yeah, amazing. On behalf of everyone of the Tech Poutine crew, I think we could thank you, John, for your time. I think it was a fascinating conversation. Much appreciated.
Thank you for listening to Tech Poutine. If you like the show, please subscribe or leave a review.